And welcome back to the Financially Simple Experience. Today, friends, I want to talk about planning your future or telling the future what you want to accomplish. And we're going to do that by examining the power, dynamos is the old Latin term for that, the power, dynamite of a pro forma. Now, none of us can tell exactly what is going to transpire in the future. We obviously know that. It's undoubtedly that at some point in a month's time, when I'm meeting with clients, they'll ask me a question as if I can predict the future. And I often will laugh and say, I dropped my crystal ball a couple of months ago. I wish I had it because I can tell you exactly what's going to happen. You know, none of us can predict the future. If we could, perhaps we might go out and buy that winning lottery ticket, know exactly what that number is going to be. Or if you're an old country boy like me, you'd figure out where to position your tree stand so you'd have a good opportunity to make that connection with that Boone and Crockett buck. Or maybe if you're a fisher, you go figure out where that lunker is, where that big 10-pound plus largemouth bass is hiding. Maybe you're like my wife and you would figure out where the best sale is going to be. And she would spend her time tracking down the best sale. She loves that. I love that about her. Yeah, none of us can predict the future. I'm reminded of the movie Back to the Future, where we have Marty McFly, and he travels back in time in the first part, then in part one of Back to the Future. And as he goes back in time, he's holding a picture of a Polaroid in his hand. And he's able to examine that Polaroid throughout the movie, and his actions back in time directly affect the future and the outcome of the future. So just like that Polaroid, that snapshot, we want to put that as a backdrop on how a pro forma can work for us in our business. So in order to understand it, we need to dive into the academics and look at what exactly is a pro forma. Pro forma is a Latin term meaning for the sake of form or as a matter of form. So it's just a Latin term. Investopedia describes a pro forma as, quote, a method of calculating financial results using certain projections and presumptions. However, here's what's interesting. When you deal with a pro forma, they're not always calculated using GAAP or general accepted accounting principles. GAAP is what's often illustrated. They are often a hypothesis. It's really an educated guess. It's almost like you're holding your finger up in the wind, trying to figure out exactly which way the wind is blowing at that moment. So how is a pro forma design, or how is it calculated? Look, there's many templates available online. In fact, we have a template that you can download from financiallysimple.com. We'll put a link for our pro forma template in the description below. But there's many pro forma templates available online. So once you get your template, then you can begin filling in the data to calculate or to run an illustration for a pro forma. There's a few different methodologies. I personally use all three of these methodologies and blend them together whenever I create pro formas. The first one is pro forma forecasting. Basically, you're estimating your total monthly income or total annual income, and you're adjusting it for seasonality of sales or the sales cycles. I can remember the first time I did a pro forma, I was like 16 years old, and I was trying to estimate the amount of income I was going to make in my landscape business. And we had a little bit of a curve because of at that time, the summer-winter times in the South. Now, it was far deep South, and a winter for us was 60 degrees, but nonetheless, the grass would not grow as much, and therefore, if we didn't measure right, we would lose profitability during the non-growing seasons. However, during the growing seasons, we'd have an influx of new clientele. So I used a pro forma all the way back at 16 years of age to try to figure out my monthly income, and little did I know that what I was doing was pro forma forecasting, using total monthly income. You can also take pro forma forecasting and estimate expenses specific to your industry. So for example, once again, as I looked at my mowing business, I could see that in the summertime, I would have more expenses. I would use more fuel. I would use more time. I would use more weed eater wire. I would end up going through my tires on my equipment more. I'd have more oil changes in the summertime than I did in the wintertime. And so I could not only estimate my revenue, but I could also estimate my expenses. And ultimately, that would provide for me some sort of a hypothetical net income. Now, it was purely an educated guess, and I could not exactly tell you how much money I was going to spend in the future, but nonetheless, it allowed me to think about what was going to happen. So in a simplicity, a pro forma is taking a forward look based on historical data and showing a revenue line and an expense line, which ultimately drives a net income line so that you can make decisions on your company. Now, there's several different types of pro formas. What I was illustrating before might be considered a budgetary pro forma. You're taking an unknown data point, you don't know all the details, and you're trying to say, here's how much money I'm going to budget toward oil changes in July. Here's how much money I'm going to budget to fuel purchases in July at the peak mowing season versus December at a weak mowing season. That's a budgetary movement. Another movement that may be is an income statement or a P&L movement. Oftentimes, and this is where I typically would start out, is I would download from QuickBooks or Peachtree or whatever accounting software you would utilize. I would download my historic P&L or income statement into an Excel format, and that became my baseline for each of the categories that I wanted to track. So all of my chart of accounts is what they're called. All of my categories of expenses or revenue will end up being the base numbers for me to project forward. So for example, if I had wages at, let's say, $100,000 this year, then I could project out in a year from now, wages might increase due to pay wages or due to tax increases or due to overtime or due to hiring more people. So I could calculate how I saw the business growing and directly impact my wage movement year over year over year. That's what's called a company pro forma based on an income statement. Or you can do a pro forma based on earnings projections. You can also think like an investor and say, okay, take your income statement historically and add it to an Excel spreadsheet, and then you can project how much earnings do I want to achieve. Do I want to see my margin increase from 7 to 15? If so, what has to be done? How much revenue or how much tightening of my expenses do I need to yield a 15% margin rate on my company in 12 to 18, 24 months? So there's multiple of ways that you can approach designing and building a pro forma. Now, what I like to personally do whenever I design pro formas is I like to blend the three of them. So what I'll typically do is I'll download, as I mentioned earlier, my income statement, including all the chart of accounts, and I'll upload that into an Excel document with an average or a previous 12 months expenses. Sometimes, depending on if I want to see the trend, I may upload the previous 3 to 5 years. And so in column A of my Excel sheet, it would have income from 5 years ago and expenses from 5 years ago based on category, and then 4 years ago. And I would be able to see that, hey, my revenue went from $1 to $10 over the last 48 months. That trend then gives me measurements. Maybe it's growth rates. Maybe it's I can see the bell curve of my business. I could see the apex to which my business is growing. I could see where my expenses might have ballooned or might have contracted in a particular category within my budget. So side by side, I can see those on the previous year or 4 or 5 years previous. Then what I'm able to do with my historical data is I'm able to project out, what margin do I want? What is my earnings projections that I truly desire? Do I want to run a margin rate of 40% in 5 years? That would be industry best, perhaps, for your business. Maybe I want to see a revenue number. Okay, if I was producing $10 in 48 months from now, I want to see $50, so to speak, in revenue. So now what I'm able to do when I build a pro forma is I'm able to start with historical data and then decide on what my objection is. Is my objection to drive revenue, margin, reduce expenses? What is it? And based on whatever my objection is at that particular time in my business, I may use an income statement pro forma, I may use an earnings projection, or I may use a budgetary document in order to design a pro forma. That is a hard exercise. That is a timely exercise. It's an exercise, however, that I feel is paramount. It's so paramount that I actually have every department within our current company going through this exercise to think about what is the revenue that their department generates, or what are the expenses that they're utilizing, and how do we increase margin? That is an ownership thinking. We talked about extreme ownership here recently on the podcast, and I'm trying to drive extreme ownership into our executive team by thinking about how pro formas can be utilized on a department basis. Whenever we coach clients and we come to trying to drive value, we're trying to bridge the value gap of their business or the wealth gap of their life. Being able to illustrate where the company is presently and where we desire it to be adds clarity to the goals that we need. Whenever I transitioned my company, as I sold my previous companies, I had tracked a pro forma for about 6 years. And I went back in time on my data points, and I had a pro forma that I had generated 4 years previous to sale. And I had an estimated income and net revenue that I wanted to achieve. And I looked at 4 years from when I calculated. So back to the future here. I'm looking at this pro forma that I had generated 48 months previously. Never adjusted, just generated it. And here I am 40 months now into the future, and I missed my net income by a margin less than 1%. Think about that, friends. Think about that. Having the ability now, as I'm talking to the prospective buyers, to say, yes, here is the pro forma that I had generated 48 months ago, and here are the results. And they're looking at this thing going, seriously? You missed it by less than 1%? Absolutely. And I had date and time stamps on this pro forma. It was apropos. It was really kind of comical for me. So I want to give you that light because there's many things that you can benefit from in this exercise of designing a pro forma. Many things you can do. For example, let's go over a few. You can secure funding. Imagine if I went to the bank, and I did, by the way, went to the bank and I said, look, here's my company's historic track record. And here are the year-by-year performance, date and timestamps that I was generating, trying to show where I want to take my company. And 48 months ago, I presented this, and here we are. We hit it within less than 1%. If you're loaning money to a business owner, would you have any problem lending money to a business owner who did that, who actually showed that they had intentionality around where they were going? They had reasonable assumptions. They had reasonable growth rate. They had reasonable expense rates, and they missed their net margin by 1%. You wouldn't have a problem whatsoever. In fact, when I took my pro formas and my package to the bank to secure funding, there was no issue. I was able to easily secure funding if I wanted to continue to drive my business forward using a debt possible strategy. So you could secure funding with a pro forma. The other thing you can do is you can inspire the confidence of your prospective buyers. You know, we never know whenever opportunity is going to present itself. Had I gone back in time 48 months, and I think that I would have the opportunity to sell my business 48 months later when I was designing that pro forma. No, that's not what I was thinking. I was thinking, how do I drive efficiency? How can I improve profitability? How can I decentralize myself? And as I'm thinking through that pro forma, looking at the revenue trends and et cetera, I'm designing this with all this in mind. And I had a narrative that went with it. And now the buyers are looking at this, literally saying, are you kidding me? You're less than 1%, 48 months? Where are you projecting right now? And I can say, here's where I'm projecting right now, all things being equal. And their confidence on my abilities to achieve that goal was not only seen in the purchase price, but it's also been seen in the promotions that I've received since I joined the company. Because being able to tactically predict where you're going to be in a pro forma inspires confidence in your potential prospective buyers. Now, the prospective buyers could be somebody external. It could be somebody internal. So now if you couple those together, let's say you're trying to sell your business to your child or to a key employee. If you couple a good pro forma along with that business sale, and now your child or your key employee goes to the bank with here's your pro forma, and here is how you, the exiting owner, are going to help provide success toward that end going forward, it inspires a lot of confidence not only in the buyer, in this case your child or key employee or an external buyer, but it also inspires confidence in the bank to lend them the money to buy your business. Pro formas matter. As you look at a pro forma, you can also start looking at your return of capital, return on equity. And a pro forma will give you a target to say, here is when a potential M&A, merger acquisition, makes sense. See, the pro forma can illustrate into the future what your rate needs to be. Now, let me break that down to layman's terms. If I have, let's say, $10,000 cash or $1 million cash, and I invest it in the equity markets, I would expect an equity market return, whatever assumption you would use for your own particular position. I would expect that. However, if my business is returning less than what I could achieve in the equity markets or my assumptive return of the equity markets, then it may make sense for me to dispose of my business at that particular point. So a pro forma will help you determine when M&A makes sense. And finally, it is a powerful risk analysis tool. You see, as you start looking historically about where you've come from, all the events that you've navigated, pros and cons, strengths and weaknesses of your organization, you're diving down to the data, looking at your revenue, looking at your expenses, looking at the margin or the profit of the company for the previous 3, 4, 5, 6, 7, 10 years, whatever it may be on your timeline. And now you're thinking about strategically where you want to be. An analysis of a projection on your expenses or your income allows you to think in terms of risk. You've heard me talk about company-specific risk and how in order for us to drive the value of our company, we must reduce our company-specific risk. It's a must. A pro forma is an amazing tool for us to think through that exercise. As I mentioned earlier, whenever I design a pro forma for my own company or whenever I'm working with clients or even now our corporation on designing pro formas, I'm trying to envision what's our revenue going to do and then what will we need to accomplish said revenue goal. How many new clients will we have to have? How many new products will we need to launch in order to receive such goal? So I'm looking at my revenue numbers analytically. I'm trying to determine if my marketing and sales team can deliver the amount of revenue that I'm anticipating. What would it take for me to achieve this particular revenue goal? Simultaneously, as I'm looking at my expenses, I'm not only looking at what can I cut, but I'm also looking at which expense is not going to scale. So for example, if I have rental property, like we're renting our office, if I drive more employees, my rent doesn't necessarily go up until I'm at capacity. So I may be looking on my rent and saying, okay, it's constant right now based on the contract we signed, but in 5 years, if I double my employee base, I'm going to need to have a new location to go to. See, I'm able to think strategically through that as opposed to being reactionary in nature. But when it comes to risk mitigation, I'm looking at things within the business which could stick their head up and ultimately erode margin or decrease EBITDA. That's what I'm looking for whenever I'm running a pro forma. So there's many things that can have that happen, and every business is going to be different. Nonetheless, a pro forma does allow you to isolate risk. So let me challenge you with this. Number one, do you have a pro forma? If I were to ask to see your pro forma, could I see where you're at today and where you desire to be? Does your company have one? Like Justin, no. Okay, or Justin, yes, great. If you don't have a pro forma, let me challenge you to go ahead and create one. If you don't know how to create one, reach out to us. We have a team of business advisors that can walk you through this and many, many, many other things. But maybe you do have a pro forma. Maybe you've taken the time to design a pro forma. You keep it up to date. What is the biggest risk that you're seeing? And how are you going to mitigate it? See, this is the time right now. Early Q1 is when we should be looking at our pro forma, trying to decide on how we're going to reduce our company specific risk. And that pro forma not only is a 12-month view, but it could be a 5, 6, 7-year view. Let me ask you, how are you going to reduce your risk? Or number two, at what point over the next 60 months, 5 years, are you going to have your capital return less than, potentially, the equity markets? Will it happen? Does that mean that you should consider an exit in the next 60 months? What about this? What about cost of capital? Are you receiving the return on your assets that you need? This is what a pro forma and so much more can help you with. Like, Justin, I'm lost as a ball in high weeds, man. That's not who I am. I'm just an old country boy who likes to go hunting and fishing. Yeah, me too. Me too. I often say that. I'm just an old country boy. Born and raised on a dirt road, live on a gravel road now in East Tennessee, looking at the beautiful mountains. I'm blessed. We all are if we want to think about it. But friends, this action of a pro forma, if you slow down, spend a little time with your consultant, your business advisor, thinking through where do you intentionally want to steer your business. This is a paramount step. Again, if you need help, reach out to us. This is what we do day in, day out. We can show you how to use a pro forma to drive closure on your value gap and your wealth gap. You can reach your goals. You can. I'm living proof. So friends, until next time, I realize life is hard, life is complicated, and dealing with this level of detail in business for many of us is frustrating. Doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great one.